In this episode of Ray TV, I'm talking about the 6 things not to do after applying for a mortgage. Hi, I'm Jennifer Ray with Jennifer Ray Homes and Keller Williams. Once you have found the right home and applied for a mortgage, there are some key things to remember and keep in mind before you close. You're undoubtedly excited about the opportunity to decorate your new place, but before you make any large purchases, move your money around, or make any major life changes, consult with your lender, someone who is qualified to tell you how your financial decisions may impact your home loan. But in the meantime, here's a list of things you should not do after applying for a mortgage. They're all important to know, or simply just good reminders for the process. So number 1 is do not deposit cash into your bank account before speaking with your bank or lender. Lenders need to source your money. They have to know where it's coming from and trace it. And cash is not easily traceable. Before you deposit any amount of cash into your accounts, discuss the proper way to document your transactions with your loan officer, because they will see it and they will ask you about it. Number 2 is do not make any large purchases like a new car or furniture for your new home if it's going to go on your credit report. New debt comes with new monthly obligations, and those new obligations create new qualifications. And people with new debt have higher debt-to-income ratios. Higher ratios make for riskier loans, and then sometimes qualified borrowers no longer qualify. If you are going to pay cash for the items and still have money left over for closing, then go for it. Number 3 is do not co-sign other loans for anyone. When you co-sign, you are obligated, and it goes on your credit report. With that obligation comes higher ratios as well. Even if you promise you won't be the one making the payments, your lender will have to count the payments against you. Number four is do not change bank accounts. Remember, lenders need to source and track your assets, and that task is significantly easier when there's consistency among your accounts. Before you transfer any money, speak with your loan officer. Number 5, do not apply for new credit. This is like number 2. It doesn't matter whether it's a new credit card or a new car. When you have your credit report run by other companies, multiple financial institutions, mortgages, credit cards, auto, your FICO score will be impacted. Lower credit scores can determine your interest rate and maybe even your eligibility for approval. And lastly, number 6 is do not close any credit accounts. Many buyers believe that having less available credit makes them less risky and more likely to be approved. That is incorrect. A major component of your score is your length and depth of credit history, as opposed to just your payment history, and your total usage of credit as a percentage of available credit. Closing accounts actually can have a negative impact on both of those determinators for your score. Any blip in income, assets, and credit should be reviewed and executed in a way that ensures your home loan can still be approved. If your job or employment status has changed recently, share that with your lender as well. The best plan is to fully disclose and discuss your intentions with your loan officer before you do anything financial in nature. That's a wrap for today's episode of Ray TV. Thanks for watching, and if you have any questions, text me, DM me, email me, or leave a comment below. And as always, make it a great day.